Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here today for CPI Day. Joining me is Greg Dacko, chief economist at EY. He's also the VP at the National Association for Business Economics. And of course, my fellow columnist, Allison Schrager. She's also a senior fellow at the Manhattan Institute and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. The outlook today, your Wall Street consensus is that CPI is going to come in 0.3% month on month for the month of February. On a core basis, that's excluding food and energy, also expected to tick up 0.3%. And if you translate those into year-on-year figures, that would be a 2.9% for your headline and a 3.2% for your core. Greg Dacko, it looks early to expect direct impacts from tariffs. Some of the changes were effective last month, but most, I think, are still in the threat stage or, are starting to be implemented here in March. How should we think about these numbers that we're seeing today? How important is this momentum that we carry into the tariff threat?
Yeah, I think there are two very important elements here. One is the momentum, as you said. We're still in this disinflationary period where you're seeing disinflationary dynamics before the onset of tariff and trade uncertainty. But we're starting to see the implementation of some tariffs. 10% tariffs on March 4th were implemented in addition to the 10% that were already implemented on China on February 4th. So you currently have 20% tariffs on China. Then you have a lot of uncertainty around the 25% tariffs on Mexico and Canada, which were in place, then suspended, then reinstated, then partially suspended. So there are starting to be some inflationary pressures that are building up on the tariff front.
Yeah. Related to that, what about these indirect effects from tariffs? Are you expecting, for instance, that consumers might rush out and try and buy things ahead of tariffs and that could create actually a little bit of an inflationary impulse itself?
I do think so. I've spoken in the past about PIA. It's preemptive inflation anxiety. And you're seeing that on the consumer front and on the business front. On the consumer front, you're seeing consumers being extremely focused on price levels, price shifts. There's tremendous inflation salience on that front, and they're rushing anytime there is any type of significant price pressure. You saw that last month with egg prices. On the business side, you're also seeing preemptive ordering and importing ahead of any potential tariffs. That's putting strains on supply chains and leading to the very inflation that people are trying to avoid. So those two elements are very important to keep in mind when we're thinking about inflation dynamics, not just for consumers, but also from businesses.
Okay. Allison, so Greg thinking about this concept of the PIA, what about markets here? It seems like we're getting a little bit of a whiff of stagflation fears out there. Bond yields still pretty elevated, break evens quite elevated, certainly at the 2-year horizon. And the stock market, I guess, save for a little bit of a bounce in futures this morning. Stock market not looking so good in recent weeks. Are these sort of stagflation vibes that I'm seeing in markets? Are they overblown here?
I mean, I think it's a little premature to say we're going for stagflation. I mean, we've discussed before, even when everyone was thinking the best of all the Trump policies, that inflation might come back. I think whether or not we're going to head into recession, I mean, certainly a possibility. I'm a big believer, that, booms don't die of old age. They die because of a shock. A big we don't know what Trump really even means with tariffs yet, but if we just did enact a major global trade war, that would count as a shock that would bring on a recession. But we still, I think it's really just the markets are falling really more on uncertainty more than really sort of serious. I mean, there's some weak points in the data, but rather than sort of actual weakening economic conditions.
Yeah. And to your point, it would be so unusual if we went into a meaningful slowdown or even a recession just from uncertainty itself. We still don't totally know where these policies are going to lead us. And I think a lot of what's causing the jitters in markets today is the uncertainty itself, the idea that consumers don't exactly know what to think. I guess corporate executives don't know exactly what information to act on here. But here comes your CPI number. Okay, so CPI month on month comes in at 0.2%. That's a little bit lighter than the expectation. Your core comes in 0.2%. Again, the street was expecting 0.3%. So a little bit encouraging there. You go ahead and translate those into year-on-year figures. That ends up being a plus 2.8% on your headline CPI, and then plus 3.1% on your CPI X food and energy. Greg Dacko, first blush, what do you make of that?
This is at first sight, this is a good read. It does indicate what I was telling you earlier, that we still have disinflationary momentum in the pipeline, and that's been building for essentially a year and a half, 2 years now. You still have consumer caution in the face of higher prices. Consumers don't really care about inflation in and of itself; they care about price levels. And anytime prices are rising too fast, they're being more cautious with their outlays. So that is one element of the disinflationary trend. I need to dig in deeper into the shelter cost inflation, because that's been a key restraint in terms of some of the pressures on the inflationary front. But core inflation rising 0.2, again, below expectations, one of the lowest readings in the most recent past. And you're seeing that inflationary trends, whether short-term inflationary trends or 12-month inflationary trends, are actually easing further. So that's very encouraging, especially in light of what we just discussed, the fact that you have brewing tariffs that are either implemented or threatened, and that could lead to renewed inflationary pressures in the coming months.
Yeah. Allison, here's another report that maybe give us some reason for optimism. Of course, we're going to see what happens with PPI and what that tells us about PCE, the Fed's favored gauge here. But I've been making this point for a little while. Base effects are going to start kicking in here. In the coming months. If this administration had just said hands off, I feel like we could have realized a pretty positive disinflationary story in the months ahead. Why do we have to mess with it?
I don't know. I mean, it baffles me every day, because I'm just looking through the data, and it's low really across the board, and really a lot of it's coming as well from lower energy prices. Although CPI less food and energy is also looking good. I mean, Trump did inherit a pretty solid economy, and with the potential to sort of even juice it up further. So I don't know. We're told we're going to a better place. He hasn't articulated what that place entails. Yeah,
a magical place of unicorns, rainbows, and tariffs.
A place where I'm not where I guess people make more things.
All right. Well, I do want to dig under the hood here, but let's go to a quick market reaction, just so you can get a sense. Big drop here in the yield on the 10-year Treasury note off of the back of this. We were trading in a range of around 4.3, 4.31% going into the number. We see sort of a knee-jerk reaction down below 4.28%. We even got as low intraday as 4.25% as the market tries to figure out its path for today. I do want to get into a decomposition briefly and see what's going on under the hood. But Greg Dacko, I also want to ask you about inflation expectations. We know that inflation expectations tend to be self-fulfilling. Inflation expectations are an important component in the way economists have modeled the trajectory of inflation for a long time. But we're getting all kinds of very different pictures on inflation expectations from New York Fed, Mitch. What do you make of inflation expectations here?
I think we have to be a little bit cautious with the different readings because they're not all pointing to a sharp acceleration in inflation expectations. Of course, the University of Michigan Consumer Sentiment reading of inflation expectations that surged in the past month over 1%, a percentage point, with short-term inflation expectations 1 year out rising to above 4%. So that was a bit of a concern. But then later on, a reading that I tend to favor, which is the New York's Fed inflation expectation reading, showed that essentially inflation expectations are relatively steady around 3%. It's too high for comfort, but it's relatively steady around 3%. So there is a little bit of upward pressure. People are anticipating these tariffs. They're aware that these tariffs are inflationary and that they cause essentially a pass-through effect from businesses, from importers to businesses onto consumers. So that is really the concern there from both a real economic activity perspective, but also from the Fed's perspective, because they certainly don't want inflation to become entrenched with inflation expectations rising. I was just looking at some of the details here in terms of the February print. It's good all around. I mean, core goods only rising 0.2%, in part due to used car prices, but new car prices fell. Core services only rising 0.3%. Shelter only 0.3%. That is towards the lower end of the post-pandemic readings. Hotel prices only 0.2%. Medical care prices 0.3%. Airfares down 4%. That lines up with some of the hearings that we've been hearing from the earnings reports that we've been hearing from some of the large airlines that are talking about more reduced demand. And even in the consumer confidence survey from the Conference Board, the reading that vacation plans over the next 6 months have fallen to a 3-year low. So more caution there. And finally, one thing that's been very important, car insurance prices only rising 0.3%. There were a lot of worries about the 2% increase last month. That's no longer the case. We're still on this slower trend when it comes to this rise in auto insurance prices.
Maybe Doge is disinflationary. I mean, is it one of the reasons we're having fewer, or the airlines are struggling, is we have fewer business government workers flying?
So here's a question. So we talked about airfares here. We talked about auto insurance. One of the key things to bear in mind here is that these things are measured differently in the PCE, right? The number that that the Federal Reserve really focuses on, and I think it's extra important to think about this because just last month, we got quite a bit of whiplash in the story, right? We had a pretty bad CPI number, and then I think the next day or the same week, we got the PPI numbers, and we realized, whoa, when we map all of this to the PCE, this is actually going to be a pretty decent number. Greg, you have any sense, looking at the decomposition here of what the read-through might look like, and what some of the areas of uncertainty still are going into tomorrow's PPI numbers?
Yeah, so we'll have to see what the PPI numbers actually show to get a better idea of what the PCE readings will show. But all in all, when you get a 0.2 read on both CPI month over month and core CPI month over month, it's generally an indication that the PCE readings will be in that range, if not slightly lower than that. So I would anticipate that we're going to see some better news even on the PCE front as we move forward. Again, this is this unusual story where you have a lot of disinflation momentum that was in the pipeline, and we had been anticipating this disinflationary momentum to carry through at least through the first half of 2025, because we initially had anticipated that tariffs would take a bit longer to be implemented. We hadn't necessarily anticipated that the administration would use emergency powers to implement these tariffs right off the bat, the International Economic Emergency Powers Act, for instance, and implement those tariffs immediately. And so what we've seen so far is, as we were talking about earlier, the implementation of 10% tariffs on China, on all imports from China, starting in early February, then another 10% in early March. now this uncertainty around 25% tariffs on Mexico and Canada, as well as today, 25% tariffs on steel and aluminum imports from all of our trading partners. Those are going to be brewing pressures that will pass through relatively quickly onto consumers because they're both final goods and raw materials that put upward pressure on inflation.
Do you think, though, that the market is really taking seriously 25% tariffs on Canada and Mexico? I mean, Trump was pretty explicit all along that he wanted to bring tariffs on China. And honestly, Biden did too. And I think, there's a security argument for that. I mean, I still find the 25% tariffs on Canada and Mexico somewhat unbelievable. Although, definitely, anything's possible with Trump. Do you think markets really are taking that seriously, or are they just responding to the uncertainty?
I think markets are responding to the uncertainty to a large degree. And you can see that in the market reaction to the announcements and then the retraction of some of the announcements and the confusion in terms of what the policy direction is. To some extent, there is even confusion coming from the administration as to what tariffs are implemented, which ones are not. We saw that as a random example with the so-called de minimis exemption. And this matters a lot for inflation dynamics. The de minimis
Can you say what the de minimis is, Greg?
I'm sorry?
Can you say what the de minimis exemption is?
Yeah, it's this rule that essentially exempts any package that's worth less than $800 per day per person. When it comes into the country, it's not subject to tariffs, even if it comes from China, and even if the tariffs on China are X%. At one point, earlier last month, the administration said that they were ending this de minimis exemption. That affects about $50 to $60 billion of goods that come into the US every year. So it's a pretty significant chunk of our imports, and mostly from China. Now, that end to the exemption created mass confusion as to how to impose tariffs, who would be doing so, how the US Postal Service would have to navigate this, and then it was reinstated. The exemption was reinstated. So that type of confusion is extremely difficult to monitor and assess the potential risks. And so the volatility we're seeing in markets, I would argue, is in large part reflective of this uncertainty as to what the final state of tariffs will be. Let's remember, we still don't have tariffs on Europe, for instance, and those are likely to be coming. So let's consider the broader scope of things. And I think the risks are really tilted to the downside in terms of growth and to the upside in terms of inflation dynamics.
Maybe we'll get a VAT instead of taxes and tariffs on Europe. You said that. I've always wanted a VAT. I mean, I don't want to pay a VAT, but as a tax person, I've always just loved them.
Well, I think it's a potential alternative. But what I'm fearful of is the lack of a destiny, right? What is the final objective? We've heard from the administration that there's a desire to reshore manufacturing activity, bring back manufacturing to the US, as well as generate revenues from tariffs to pay for some of the extension of the tax cuts or potential new tax cuts. But I'm not necessarily clear as to what the end goal is and what the overall strategy is. We haven't heard essentially any concrete plans as to a revamping of the tax code that could potentially include a VAT tax, a value-added tax. So I'm with you with the possibility of reorienting, establishing a new tax code that potentially could actually generate more revenues and put the U.S. on a firmer, more sustainable fiscal trajectory, which is also part of the question right here.
Yeah, I only say that
Big
because
priority
he's
there.
saying that the VAT, he sees the VAT in Europe as sort of a violation of our sort of as a tariff, although it's definitely not. But I guess when it comes to reciprocal tariffs, maybe it's not as part of tax, but maybe it's now a trade policy, which would not be the reason to do it. But you don't always get what you want for the reasons you want.
Well,
That's right.
it's so true, and it just strikes me that a lot of what the administration is trying to do is say we have these problems and they're completely other people's fault, right? Part of the reasons that we have some of the trade imbalances that we do, and part of the reasons that we have the fiscal deficit problems that we do, is because of choices that we've made along the way and how we were going to finance our government. Right. A lot of other countries have a consumption tax based model or sort of a fusion model. And in the United States, we have a very income tax based model that oftentimes doesn't help us at the WTO, the World Trade Organization. But to your point, Allison, like, what is the obvious solution to that? Maybe we align our tax structure a little bit more with every other country in the OECD, rather than going around the world and saying, tisk, tisk, you must, change your tax policies to give us greater advantages. It seems like this administration really wants to put the onus on everybody else instead of doing the hard work of tax reform and things that take political consensus building at home.
There's also the wild theory that I like to believe, because I just like to be positive, but I'm finding harder to maintain, is that this is really all about lower tariffs in the end. Like, we're threatening high tariffs to bring tariffs down.
Well, but Allison, I think that's exactly the thing, and your point is exactly right here. That makes some sense if you give your counterparts an off ramp, right? Mm-hmm. But in the case of Europe, if you're saying we're going to do reciprocal tariffs if you don't bring down your tariffs, but we're including as part of reciprocal tariffs the VAT, you don't give Europe an off ramp, right? Mm-hmm. They're not gonna eliminate their VAT. It's essential to the way they finance themselves, and so you set yourself up in an impossible negotiation. Do you agree, Greg?
Yeah, I think I agree. I mean, my perspective would be the following: in an environment where there are mismatches in terms of tariffs, the broad objective should actually be to lower the cost of trade, right? That would be any country's goal, should be any country's goal. And there is always this misunderstanding when it comes to tariffs that somebody else pays the tariffs, and it's simply not the case. So much so that in a trade conflict, it's actually optimal not to retaliate, because by retaliating, you're essentially imposing an additional burden on your own consumers, your own producers, by increasing the cost of the goods you import. So I fully agree with Allison's point that maybe the final objective is to lower tariffs, but we're not going about it the right way in terms of obtaining those, because what's happening is that a lot of countries are now aware of the Trump administration strategy of raising tariffs, and they're retaliating in kind. Europeans this morning, after the implementation of steel and aluminum tariffs, imposed their own tariffs on U.S. exports. About $26 billion worth of U.S. exports to Europe are now tariffed. Canada is retaliating in kind, and we saw yesterday a lot of back and forth when the Trump administration threatened 50% tariffs on steel and aluminum exports from Canada, where Canada was essentially raising the price of electricity it was exporting to the U.S. So I fully agree with the final goal. I'm not sure we're going about it the right way.
You think that is the final goal? I mean, I genuinely don't know. I
would say my ideal is to have a lower cost of trade. I don't know what the administration's goal is.
But that seems to be precisely. Go ahead, Allison.
I think there are a lot of tariffs out there. Like, I wish India would lower its tariffs. Maybe that's what we're doing. And there's this rather odd essay I saw in Free Press from Michael Lind trying to argue that India has benefited from its tariffs, but I think it's really hurt their development. So, I mean, maybe this is all a big ploy to lower their tariffs.
Well, it could be part of it, right? But the thing is, there are so many things going on at the same time, and it's impossible to believe that they all have the same objective. I think Greg's point, right? I mean, there is a strategy called the reciprocal tariff, and it would make sense that the goal of the reciprocal tariff is to get our counterparts to bring their tariffs down. I think the reciprocal tariff plan goes into effect April 2nd. As I outlined, I think there are some problems with that strategy if you throw the VAT into the mix. But it could be that the goal of the reciprocal tariff is to bring down tariffs overall. But what about all this other stuff? Again, you start talking about drugs, you throw China into the mix, which is really, I think, just its whole own animal. And I struggle to believe that the objective is the same, or at least, or even related in every case.
Yeah, I mean, you're absolutely right. So the reciprocal tariffs, there are two approaches to reciprocal tariffs. You either lower to the lowest rate of your trading partner, or you raise rates to the higher tariff rate that the other counterparty is implementing. I'm arguing that the lowering approach is actually mostly beneficial to all economies around the world. Now, we have to remember that part of this perspective of raising tariffs on trading partners is aimed at protecting domestic industries, reshoring activity that was lost back in the early 2000s when China came onto the international scene. The misunderstanding there, and what is mislabeled, is this notion that you're going to bring back jobs. The jobs that we lost 25 years ago are going to come back, and the activity that we lost 25 years ago is going to come back. That's simply not the case. Manufacturing today is very different than it was 25 years ago. It's much less labor intensive. It's much more technology oriented. And you need different types of skills and jobs to fulfill those activities if you bring them back into the US, especially once any type of government subsidies expire. The real cost of producing at home is higher. There's no going around about it. The real cost of producing at home is higher unless you strive to drive much, much higher productivity growth, because the cost of labor is so much higher than in other places around the world. That is really what should be the aim, essentially focusing on strong productivity growth, and that would lift the supply side of the economy and alleviate inflationary pressures. That, in my opinion, should be the key priority for any administration that comes into power.
I think one thing we could take away is it's like a problem that none of us know what the point of this is and what the end goal is. And I think that just demonstrates like just how much uncertainty, everyone's facing.
I'll say, and and we're on a live stream here with the chief economist of EY, and Allison, you and I have the benefit of being able to check in with our Bloomberg terminals every morning. Imagine what every other person in the world is thinking of all of this. It must be absolutely mind-boggling. But let me just try and bring this home here in our last 3 or 4 minutes. We have a Fed decision coming on March 19th. It will be one of the more interesting ones because we get a new summary of economic projections. We get to see what policymakers are making of the economic outlook. There's also a particularly fascinating slide that I will be going straight to that gives us a sense of what they think the risks are around their forecasts. Greg Dacko, what will you be focused on there on March 19th?
Well, I think what we're going to be keenly focused on is essentially the messaging from the Fed, because what we have is essentially a lot of uncertainty regarding the direction of travel of inflation in the near term, and questions around the durability of the U.S. expansion. I don't think we're headed into any type of recession in the next 6 months, for instance, because we have a lot of positive momentum, but you're starting to see some fundamental cracks in the consumer picture that predate tariffs. Income growth is slowing. The labor market is cooling. Add to that uncertainty where businesses have essentially a marginal cost of zero of not doing anything in this uncertain environment. And that could lead to further slowdowns in business investment, in hiring, and that could precipitate more of a slowdown on the consumer end, especially if you add to that the inflationary pressures. That is a mix that I think the Fed is going to be very conscious of and cautious about in terms of balancing both sides of the mandate. So we're going to be paying very close attention to any communication as to whether this is a prolonged pause in the easing cycle and what type of inflation outlook the Fed is expecting and what type of a labor market the Fed is expecting.
Okay, Allison, same question to you. What are you looking for on March 19th?
I think I'm just gonna really look. I don't think we're gonna get a lot. I think they're just gonna hold, and I think we're just gonna sort of enjoy watching Jay Powell do some gymnastics of trying to be like, we have these projections, we have no idea what's gonna happen. We're independent. Yeah, we're good. I think that's just gonna be interesting to watch, but he doesn't know any more than we do.
The Simone Biles of monetary policy. All right. I can't wait to see it. Yes. Thank you very much to Greg Dacko. Thank you very much to Allison Schrager. And thank you to everybody who tuned in. Join us for Fed Day when we do another live react. My name is Jonathan Levin, and we'll see you again next time.